Hello and welcome to another financial analysis video. Today I'm talking about General Electric, and GE has taken its lumps in the financial media over the last several months. The stock hitting another fresh 52-week low on Friday. It is down 20% from a year ago. And just a number of things going on here. I do want to focus in, however, on the dividend. That's recently come under pressure. And, the dividend is yielding over 4% now for GE, mainly due to the decrease in price. But also, the company had increased its dividends slightly in 14 and 15. So it's not all due to price pressure. But the company has had its share of earnings concerns, and you can kind of see some of the downward trend here. It is meeting or beating earnings expectations, but the expectations continue to be a little muted. And, if we look here, we could see the earnings growth numbers over the last few quarters have been flat or down, and now, down 15%. Part of that, though, is also the fact that the company has gone through some downsizing. It's getting smaller. It's trying to become a little more leaner. Synchrony Financial spinning off was probably the biggest piece of this. But, GE has been selling a number of different business lines and whatnot over the last couple of years. One thing that does bring me a little bit of optimism here with GE doing what it's doing is that we've seen a higher asset turnover, higher return on equity, and a higher return on assets as a result. And this despite, some revenue pressures overall, but, this tells me that in the long term, GE's plan may pay off well. Where we get into the problem and where I believe General Electric is going to have to cut its dividend is, free cash flow over the last couple of years has plummeted. It used to be able to support the dividend 2-to-1, and about 2 years ago it began to crash, and really it's been negative over the last couple of years. Also, with the earnings headwinds, the quarterly payout ratio has come close to being topped as a result of of the earnings pressures. So in the payout ratio over the trailing 12-month period is now over 75%, as indicated by this chart down here. So I think these three charts being the most important of the six I'm showing here, I think that, GE needs better free cash flow in the long term in order to bring back a growing dividend. And so as a result, I do believe that the dividend cut is imminent. So, I'd tell investors to kind of stay on the sidelines, wait for the cut to come in. We'll see what that does for the yield. And I actually would look for operating cash flow and free cash flow to improve before considering getting back into this as some sort of sustainable income investment. I hope you enjoyed this video. We'll see you next time.